My name is Michael Croker. I'm the Head of Tax here at Chartered Accountants. I'm joined today by two of my colleagues, Bronnie Speed, who looks after financial planning, and Tony Negline, who speaks on superannuation matters. So, welcome everyone. Thanks for tuning in. We hope you get something out of this. Today we're going to focus on the Hayne Royal Commission final report. I was in the lockup on Monday afternoon, and it was fascinating to hear all the different views about the report inside the lockup. But today we're going to focus on you, our Chartered Accountant members in particular, to see how the final report impacts members of the accounting profession. So without further ado, I think we'll kick things off. Just some brief overview comments. This is a very good report. It's principles based. The media haven't really picked this up, but Hayne has tried to give regulators a principle based approach on which to carry out their work. He hasn't launched a lot of scathing remarks about individuals, although he has referred some matters to the regulators for possible follow-up prosecution activity. He hasn't recommended major changes to the law. He's actually a person who wants to have more simple, streamlined processes and regulation in the financial institutions that he looked at. And so that's a good thing. Now, accountants hardly rate a mention at all in the report, which is not surprising. We work within the terms of reference. But the implementation of so many of the recommendations will involve chartered accountants. And I'm not being, special here. I'm just saying that chartered accountants impact so many levels of the business community. You'll find them in the regulators, you'll find them in commerce, you'll find them in senior positions in the financial institution sector. But the most obvious example is the chartered accountant who's working in public practice, advising individuals and business clients. So there's a whole range of recommendations which I thought in the lockup, and I subsequently shared these views with Bronnie and Tony. I think there's a whole host of issues coming out of this for chartered accountants, and it will impact the work that we do and the service offerings that we provide to our clients or the businesses that we work for. So,
and really it provides a great opportunity for some of these proposals, don't they?
Yeah, no, it is an opportunity, Bronnie, and I think we'll probably dig down now to a few of the specific areas to try and flesh out what I mean.
Absolutely.
Can I start with tax advisors?
Sure.
Because when I mentioned,
that was actually the most popular question.
Was it?
Yeah. So we've been asked the most by what do people want to know about?
That's you.
Well, I specialise in tax, and I have the unfortunate of having seen tax issues everywhere, so it makes me pretty boring at parties. But what I wanted to say to the people interested in tax matters are a few things. There's a hell of a lot of compensation coming the way of clients who have been wronged in some way by financial institutions. At an individual level, the compensation might be small in amount, but in total terms, that's a hell of a lot of money. We're talking hundreds and hundreds of millions of dollars.
Actually, probably billions.
Billions, okay.
At the end of the day, it's billions. Yep.
And really, the breadth and the number of clients impacted is quite large too. It's not like a couple of very big chunks of money going to a few people. It's equal.
No, it is spread across. So it's not only it's obviously the superannuation market. There's also the insurance issues. There's interest on mortgages. There's normal loans. There's car loans.
There's inside super. There's outside super.
There's poor advice. There's poor financial advice. There's compensation everything.
Mm-hmm.
Yeah.
Now, sometimes, Tony, as you know, that involves tax adjustments. Some of this compensation could reflect the reversal of things that have been claimed earlier as deductions. And so the compensation might take on an income, assessable income character. Sometimes the compensation might relate to an investment that you've made, and that investment is on capital account, and there's a CGT cost base adjustment to be made.
Well, if you've sold the investment, there's a problem adjusting the cost base.
Yep.
But you no longer have it.
That's right. So you've got to go back in time and think about those assessments. Now, we contacted the ATO about this last year. To their credit, they were very quick off the mark, and they did publish some material which is available on the ATO website. We've been in touch in the new year, and we've been told that the further work is being done by the ATO in terms of the specific implications for your sector, Tony, the superannuation sector, because some of the compensation is coming the way of SMSFs or other types of superannuation funds, or the way that people have invested their.
So the issues will be the issue there will be, is the compensation a new contribution? Is it on capital account? Again, CGT issues. What happens if the compensation is paid direct to the individual, not to the actual superannuation fund? Then what happens to it? So there's a lot of issues to sort through there.
Or also, what about the superannuation payment, a compensation payment is made and the super fund has then been moved into pension phase? Receive super contributions anymore. What are we going to do in those circumstances?
Yeah, correct. So there's a lot to think about.
So for people watching, the bottom line is, if you think you have a client who's been aggrieved, poorly dealt with by the banks or financial institutions that are covered by the Hayne Royal Commission, you have a few roles to play here. Firstly, can you help your client get the compensation? And I think Ronnie's going to talk about that in a minute too, in terms of what you might be able to do with your financial planners, etc. But the other thing is, if you do get the compensation, just don't let the client think it's money from heaven. It could well have tax ramifications, and you might not be popular for saying so in front of your client, but those tax ramifications have to be addressed in accordance with existing ATO policy and guidelines.
I think the other thing to add also is how far you can go back now. There will be some clients who haven't even thought about looking into whether they get a payment. Now you can go right back to 2008, and so that's a fair way back. Then there's an issue of record keeping. People do they have the records of something that's now over 10 years ago?
Now, Brian, I'm going to lean into you now, because one of the other things I think tax people need to focus on is this reference in the final report to a new regulatory environment. And we've been working hard behind the scenes to try and get some regulatory relief for our members. We're a very regulated profession. Okay, we've got the Tax Practitioners Board, we've got the Professional Ethical Standards Board, we've got the Financial Complaints Authority, and we've got ASIC and APRA at the big end of town. So Commissioner Hayne alluded to a possible new regulatory model for those people giving, financial planning advice. And Ronnie has been working really hard with FASIA.
Yes.
And so we're waiting for the development of this new Ethical Standards Authority. And Hayne seems to support the FASIA work, and he didn't want to jump on their current work. So he's going to give that time. But this idea of new regulation for some people in our profession.
Yeah, that came out as a bit of a surprise, really, that he wants to put an overarching body over the top of APRA and ASIC, three-person team to help regulate them. But on the flip side, every person who's on the financial advisor register, and there's 25,000 of us, are about to come under a FASIA code of ethics, and that will be enforced by a new FASIA code monitoring body. And what Justice Hayne said was he would give thought should be given to whether that new overarching body for ASIC and APRA actually had relationship, or how the relationship worked with the new FASIA code monitoring body. And we don't, for those of you who are familiar with FASIA, we don't yet know who the new code monitoring body or bodies will be. Applications have to go in by the 31st of December, and the successful applicants from ASIC's perspective won't be announced until later this year. So there's a lot of time between now and when we find out what's happening with FASIA. So now that Justice Hayne's come out with this, it will be interesting to see whether the two coincide or whether they are in fact another two standalone regulatory.
Now, Bronnie, Hayne suggested that financial planners should be individually registered. Is that going to be seen as another burden on
What that really does is takes us back to pre-FSR, pre-2002, FSR 2002, 2003 training, FSR training.
Well, officially R1.
Yeah.
March
Back then,
01.
so we went to the licensing regime. We're now, I think that for those of you who are listening who are in limited licensing, we'd like to see a bit of change in the licensing around limited licenses. The regulation we've got, the cost of running business under these new this new world is nearly prohibitive, so we understand that. Whether we go back to individual licensing or whether we take power away from dealer groups will be interesting, because the FASEA reforms across CPD, across the new professional year, which is in play now, across the exam, across a whole range of areas, really puts a lot of onus back onto the dealer group. So really, the dealer group is it has to be more responsible, yet the licensing may go back to the individual. So it'll be very interesting over the next 6 to 12 months to see actually how that plays out. Pros and cons of both.
So put your financial planner hat on. What really leapt out at you from the final report, apart from the things we've just mentioned?
I think the big one that a lot of advisors out there will be we're keen to see was the commissions issue. And really, we've had 5 years to get used to the fact that grandfather commissions are about to go. So I would, from my experience, most of our members have either moved to a fee-for-service model, or they are aware that they were going to go. So we would be supportive of banning all upfront and ongoing commissions. We must also, though, be aware that we don't want then the insurance companies to just take those upfront and ongoing commissions and keep them in their slush funds. What we want is that for premiums to be reduced in light of no commissions paid. We were really pleased to see also that in some cases you just simply can't either move the client into another policy or suggest that they stop the arrangement they're in, primarily for medical reasons. And it was really good to see the Commissioner suggest that in those circumstances where the individual can be clearly identified, that any ongoing commission or upfront commission will be rebated back to the client directly or to the policyholder. And so really for our members who have not yet moved to a fee-for-service model off the back of any form of commission-related business, it's time to do so. I think the other thing that was interesting was to see that the mortgage brokers and some of the people who were taken out of reforms back in 2013 under FOFA are actually back in. So the insurance commissions and the bank ongoing commissions are sort of caught now in terms of fee disclosure statements, in terms of best interest unit, in terms of, there's a whole range of things that people who were carved out are now back in. So I think they were the biggest things from an advice perspective.
And for the mortgage brokers, the fight back's already started with whole page advertisements today in the press saying this is all the good things we do for our clients, take away the commission structure and...
that won't happen. No. I'm saying they're saying if you take away the commission structure, well, then we won't be able to look after our clients. Well, I'll be thinking there's a few of them who do that. I'll be thinking there's an awful lot that are getting commissions, ongoing trial commissions, and not doing a lot for their ongoing clients.
So we accountants, we help our individual clients get loans for all sorts of reasons. Do you see an impact for those of us who perhaps want to get into the business of making sure that we put our clients in the best possible light in terms of the application process and changes there? I'm thinking in particular about business and small business loans, farming loans, for example. There seems to be a focus on the quality of the applications, getting those loan applications considered by more senior, more experienced people in the banking industry. That's good news for the farmers. I'm pretty sure our rural members will be delighted.
And I think there were some questions that came in, particularly from Queensland, from the rural community. So it's good that we...
Well, not only about farmers, they also ask about small business. Maybe deal with both of those.
Doubles up. Look, on the plus side, if we take commissions and things away from bank products and loans, etc., it's not a bad thing. But what Haynes suggests at the moment is that it's going to be, that there will be a fee paid for anyone who goes to a broker. So what it's indirectly doing is pushing everybody back to the 4 banks. Now, that's not necessarily great, because competition obviously is good for all of us. On the flip side, it's really hard to, some of this paperwork, as you would know, is so labour intensive. And given that as chartered accountants, we're not funded with commissions or any form of back payment from any of the banks, it's a real conundrum, because we can provide probably, we're the better service providers who can really help, but people who need help in applications for loans, on a lot of occasions, can't afford to pay us for it. So that's where the quid pro quo comes in. Is it good to have all upfront commissions banned on insurance and on finance products? Or is it better to have some form of, if they're going to keep them, should they be to benefit the client instead of the advisor? I'm not sure exactly where that's going to land.
That best interest duty is definitely coming like a road train, isn't it?
Yeah, and they've brought the brokers into that as well, whereas that wasn't there before.
Just speaking about small business, I'd like to touch upon the other end of the timescale that Bronnie's mentioned, and that's when things go bad, when things go sour for small businesses and our rural clients. Hayne is really big on mediation, and particularly in the rural sector, he almost goes as far as saying, foreclosure is the last resort. And this idea that mediation services are going to be pushed by the regulators and by the banks themselves under hopefully a revamped banking code of conduct. I think that's a very important place for our members to operate. Mediation is tough. It can involve a lot of hard conversations, but our profession should be used to that. And I was a bit betwixt and between in the lockup when I was thinking about this too, because we have a very important group of members who work in the insolvency space. Now, sometimes, and I don't think this has been acknowledged enough in the response to Hayne's final report, sometimes if a business is clearly uneconomic, early intervention by an insolvency professional is the best outcome for all concerned. It may not seem that way, and we hear all these horror stories, I know, but I don't think we should remove from the discussion the important role that specialists in insolvency have in dealing with these sorts of
And we also
situations.
have a group of members who are specialists in business valuations, and they come into play in this area as well.
Well, valuation's huge because
It's a licensable activity as well in many cases.
is it? Yeah. So Hayne's recommending that valuers move front and centre into particularly in the agricultural area. Valuers move front and centre into the action here. He doesn't like banks providing their own in-house valuation results. He seems to advocate quite heavily for independent valuations.
Just segregation of duties, isn't it? But he just wants it out.
And it's tough, Bonnie, because in the rural sector, he's asking those valuers to take into account the seasonality, the ups and downs of economic life in the rural sector. So a big challenge for valuers, but a big opportunity for some of our members who specialise in valuations.
Absolutely.
To step up and push their credentials as independent trusted valuers.
Do you think some of the banks might withdraw from the rural market or charge much, significantly higher rates, significantly as in say plus 100 basis points or something like that?
I'm hoping it might go the other way, Tony, because one of Hayne's recommendations is that, and rural CAs will love this, that the banks invest heavily and have these loan applications and these default applications, to put a moratorium on further default interest. Have these sort of applications looked at by experienced agricultural lenders. In Wagga, back in, when I was growing up, Dad used to go down to the bank and there was a local bank manager there. Dad could talk about his farm debt issues and financing issues. I don't know whether that's coming back in terms of a local town presence. Some banks, I think the NAB has announced it won't close down any more rural banks, but certainly in this day and age, I think there'll be a big emphasis on rural CAs and their clients being able to access hopefully a bigger, more experienced group of agricultural lenders by teleconference, video.
And then if you have the independent valuation, then therefore that is designed to provide comfort not only to the lender but also the borrower, presumably.
And the regulator.
And the regulation.
Yeah. Now, Tony, some people in CA, they end up listening to this and thinking, but there's risks associated with that sort of advocacy work too. So, crafting your letters of engagement and doing the work with the special caveats that protect the advisors in these situations, because no one's got a crystal ball when it comes to life on the land.
No.
Tony, I'm going to talk about
you can tell that from Townsville, can't you?
Oh, yeah.
It's terrible.
What's going on?
Yeah, very sad.
I'm going to talk about super.
If you must.
Now, The acronym SMSF, I googled it in the lockup that night, and
You only had about 3 million fines on Google, I mean?
no, sorry, in the report.
Oh, okay, yeah, there was hardly any there, yeah.
But is that the end of the discussion? I mean, most of our members work on SMSFs, but is there a lot in there for super?
Well, there is quite a bit in the report in relation to superannuation in general. There is an awful lot. So in relation to self-managed super funds, the only reference to them is indirectly, which will actually impact the whole sector about the hawking of products. So the whole idea, Hayne has the view that there should be no hawking of financial products, period, pretty much. Now, the government has accepted that recommendation, as indeed has the Labor Party, so it's reasonable to assume that at some stage that will be legislated, with the start date probably yet to be firmed up. But what that means is that presumably there will be a much greater restriction on the ability to run a one-stop property lending SMSF shop, for want of a better term, which may be, say, on the Gold Coast or other property developments. So it's quite common to see that advertised here in Sydney, for a lot of the apartment developments that are going on here. So a lot of real estate agents might suggest it, recommend it, so on and so forth. A lot of that's maybe much harder to achieve under this new rule, or under this proposed new rule. But the problem there is that we've got to make sure that rule, when it comes in, doesn't have any unintended consequences, that CAs won't be able to have a conversation with their client. If it's got to be a client-initiated conversation about superannuation matters, does that mean that the issue of a client's superannuation affairs can't be raised at all?
I see.
Yeah. So that we've got to make sure there's, to some extent, no unintended consequence of that. Now, that only wouldn't apply to superannuation products. In Hayne's mind, it would also apply to insurance products.
Where a lot of the banks have had active call centres going out on random calls.
I'm sure there's not many of us who haven't had phone calls from our friendly bank saying, would you like a death or disability insurance policy? Yeah.
It's very common. And we saw that come out of the commission where that poor Down syndrome boy had been contacted. I think that's where some of this has come from.
Indeed.
Yeah, those case studies make for harrowing reading, don't
Absolutely, that was just awful.
So there's not only that, there's also the issue of default funds. That's a big issue.
That's a big one.
Now, can you unpack that a little bit for me? I mean, what was wrong? What was the problem that Hayne was trying to address here?
So the problem that's trying to be addressed is that there are around about 20+ million superannuation accounts in Australia, more than that in actual fact. Probably in the region of about 25 million. We've got 10 million workers at any one time. Clearly, there's too many people. There's too many accounts, and the reason why that occurs is that the employer selects the default. Most people don't select their own fund. People go from job to job, to industry, sector to sector. Every time you join a new employer, you're joining the default. If you don't have your own and say, I want contributions into this particular fund, you're joining that employer's default fund. So if you go from Macca's to a pub to working on a building site to being a tradie, whatever it is, you can end up easily with 3 or 4 different superannuation accounts.
Before you start a full-time job?
Yeah, indeed, before you start, or maybe your first full-time job. So you've got, 3 or 4 different funds.
So what a mess. So could you explain what Commissioner Hayne means by stapling, and is that the right solution, is it?
Well, what he has suggested, and this is yet to be accepted by, so the government have said, yep, we agree with this. So the default model will be finalised depending on what legislation can be got through Parliament. So there are very diametrically opposed views about how the default model should work. The industry fund sector would like the default still attached to the employer, but when you leave one employer, all the money that you have in other superannuation funds will get rolled into that employer's default fund. Then when you move somewhere else, all that money will move into the next default fund. So their idea is the default fund is still attached to the employer, but all your money only goes into that one fund. Another model is that you join, your very first full-time job, you join a fund, and unless you move elsewhere, unless you elect to move to another fund, that's your default fund forever.
You're stapled to it.
That fund, that immediately, whatever fund you join at that time, that fund is stapled to you, and there's a one-to-one relationship, and you don't move anywhere else unless you elect to go somewhere
So
else.
if you go to another employer, you take that fund with you?
Yeah, correct. And the employer would then say, unless you elected to go somewhere else, you would belong to that fund forever. So that's another model that is on the table. Ultimately, what model? In broad terms, they're the two models. Whichever model is selected, as I say, that'll depend on what legislation can be got through Parliament. But either way, I think the current default model, where you can end up with multiple accounts, thankfully, that will ultimately hopefully die.
And Hayne had something to say about fees, Tony, being deducted from.
Yes, so advisor commissions and advisor fees and so on from my super account. So my super account is effectively a default fund.
They've only been in a couple of years too, so it's interesting there's yet another change, isn't it?
That's right. So default. His idea is that fees, commissions, etc., that may be paid to advisors, outlawed, and also he suggests on a choice environment. So. Let's say I don't like any of the defaults that are available, or I want to select my own fund. In other words, it's my own choice as to which fund I use, a retail fund, an industry fund, even an SMSF, whatever it is. Any advisor fees out of that choice model also potentially outlawed. So he's saying that we should get rid of that.
And just as a little proviso on that, because for those members of who are in this video who practice in advice and who practice having fees taken out of a super account, it's actually a tax-effective way of doing it in some instances and appropriate in some instances. But the big proviso is that it has to be at the client's written permission. So he's trying to outlaw amounts where advisor fees are set up and they just keep going.
Yes, and all grandfather arrangements. So grandfather arrangements under the old FLAC model that sort of ultimately got legislated that there was a carve out of everything that was in place. He wants all that wiped.
Absolutely.
Yeah. And everyone starts with a clean sheet of paper. Unless you have the client-specific approval for a fee, you cannot deduct.
And that's even been broadened as to who's caught under that net. It's been now, instead of getting client to sign that they want fees taken out every 2 years, it's going to be every 1 year. And therefore, so the more people, broader services, more often. It's all about making sure the client knows that if they agrees to, gives permission to have a fee taken for advice, they know about it, they sign off on it, and they direct it.
And Tony, there could be a few jobs going on trustee boards, do you think, because of independence concerns?
Well, yes, he does raise the issue of independence, and he also raises the issue of best interest duty and so on. He has a lot to say in his superannuation section. He has a lot to say about compliance of the best interest duty covenant and the regulation of that. So I think watch this space in relation to what is expected of trustees and the independence of those. So the government currently have legislation before Parliament, haven't been able to successfully legislate about the need for independence directors. I don't think that issue is not going to go away, and at some point it will be legislated in one form or fashion. So there will be a few jobs going for people who can actually be a director of a one or more superannuation funds. But then, he also talks a lot about conflicts. So he's very, very big on the issue of the fact that the conflicts of interest haven't been adequately addressed.
And there'd be a lot of sympathy for that, I think, to make sure that people are squeaky clean. There's been even talk about abolishing the ability for a super fund to take a valued client, or whether it's an employer or a group of employees, off to the MCG and put them in the corporate box and wine and dine them to get their business.
Yes, so there's a number of
shame those days are going, isn't it, really?
Well, indeed. So that he wants to fire that up and say, okay, all these things are outlawed, specifically outlawed, whether it be tickets to sporting events or similar, the opera or whatever it is you're into, as well as maybe discounts on related party. Might be discounted interest rates, or it might be an increased interest rate on a term deposit, or lower bank fees on unrelated things. So he's trying to get rid of, if you like, those related party sales incentives, or good time deals. Fine dining or whatever it is that you're after. Stuff like that. So he's trying to get rid of all of that sort of stuff.
Okay, well, that's fascinating. Now, there's a group of members, I guess, that we should think about here, and that's the members who work in advisory
and risk management.
And risk management. I can't begin to tell you how many pages are devoted in Haynes' final report, both in the final report itself and the case studies, to what you might call poor board practices and a poor communication culture between the board and senior management. This feeling that some boards don't even know who's accountable, let alone holding them to account. And so it seemed to me that those chartered accountants who work in these large financial institutions or who advise them, particularly those accountants who work in what we call a C-suite, dealing with senior management and who talk to boards, there's a lot to be done here about improving communication and making sure that the board gets the right quality information to discharge its duties effectively. These things that we saw on the TV about, we didn't know this was a problem until too late. I wish we had acted earlier. And at the management level, there's also a problem identified in terms of the ability of these financial institutions to engage effectively with regulators.
Absolutely.
This idea that you find a problem, you sit on it for too long, you don't engage effectively or quickly to get the problem rectified. And on the regulator side, there's also this sense that they haven't been as effective as they should have been either.
There's a bit of tightening up across a range of areas, isn't there?
Yeah.
And this is not our financial advice licensed members. These are members across a range of areas who are advising, aren't they, corporations and financial institutions, and they feel that needs tightening up.
It's all the product. It's the product license area, whether it be an APRA license or an ASIC license to actually distribute products. So they're the issues. It's the advice in relation. It's the advice to the people who run those products.
Yes.
Yeah. That's the real
high level.
Yeah, correct. Yeah.
So nobody's saying this is easy, but don't get me wrong. My sense is that you'll have regulators who are going to step up, be more proactive, seek responses more quickly. And on the other side, I think there will be an expectation that management in some of these financial institutions will themselves pick up and engage better. And that means having these difficult conversations, these negotiated outcomes, these mediations, much more quickly and effectively, with better line of sight to the senior management and the board that these problems have been dealt with, and this is how they've been dealt with effectively.
And I don't think we would hope in the foreseeable future we're not going to see a repetition of senior boards of financial institutions almost ignore the regulator or disrespect the regulator, which we have seen.
No, you're not going to see that. I do think the compliance and audit function of boards is going to become a really highly powered. That's in many ways, if you look at what Haynes said, that's going to be one of the key committees that the board is going to really make sure actually the people on that subcommittee are really top notch and
know what they're doing,
and know what they're doing, and know what they're looking for, and know what questions to ask of senior management.
And Hayne makes clear, Tony, that in respect of the audit committee, it's not just about financial risk.
No.
In fact, he hardly talks about that. He says the biggest issues and the problems that have arisen during his time in the chair mostly relate to non-financial risk and the inability of financial institutions to deal with that particular type of risk.
And there's a good reason as to why he didn't actually need to address that, because thankfully we've had very, very few failures, and certainly no large entity failure, no financial house failures, thankfully. He would have had a very different Royal Commission if we had had one of those failures, because we would have had to look at why and what to do about that, like HIH.
Yes.
Yeah. So we haven't had that, so we've been able to look more at the operational / systemic issues.
Now, do we have any issues we should touch upon from our
I think we've dealt with most of the questions that we have been asked.
I just think it might be an idea to, because we've had a couple of queries about the default fund, and certainly those who are in advice and those who are licensed to give financial advice, that's clearly a group of members who will be impacted. But I think there's actually a broader ramification.
Now you're talking about the default fund?
Yes.
Well, you really, if you look, you've got to look at how entities select a default fund. And if it's going to belong to the employer, then there's going to be changes there. So the default fund is pretty much selected by obviously a group of people who run a business in broad terms, the people who run the HR team, or people in culture, the CFO, the COO, the CEO, often and other senior managers, and oftentimes one or more of those people are going to be CAs.
That's right.
And so all of those people are going to have have a new job, or they will have a new job on their hands, dealing with this default fund business.
Yep.
Yeah.
And that then also filters down to all of our members who are in businesses around Australia who help other small business.
Yeah, correct.
Because all of those small businesses that our members advise will have to be up with the new rules.
That's right. So everyone's going to have a new default fund.
Yes.
We just don't quite know how that process is going to work. Or more than likely, at the very least, it'll have to be reviewed to say, yes, okay, the arrangements we've got are okay, potentially. That's the simplest solution. Whether or not that will be the solution that you'll be allowed to select is another matter. Everyone's going to have to deal with it at some stage, though.
And all of our members who are
Everyone
in
who's got an employee.
public practice themselves, a lot of them are employing people as well. So,
yeah, and they will have a default fund.
So I know that the first blush on the default fund bits was, that's to the financial advice part of our membership, whereas in fact it's not. It's to everybody who operates in the super space.
Yeah, correct. Which is pretty much everyone who...
It's everyone.
It's
yeah.
everyone.
Mm.
Yeah, it's everyone. Interestingly enough, Hayne had very little to say about the retirement sector. He's kind of left all of that to the the retirement part of the superannuation sector. He's pretty much left all of that to the Productivity Commission.
Yeah, and I know you're very concerned about the issue of financial elder abuse in the
ANZ
sector.
Yeah, elder abuse. Yeah. It's still a very live issue.
That's going to come on like a train soon. With
a
lot of sad stories emerging already about the what happens next at that stage of life in terms of the guardianship roles, the people who's in the corner of these poor people who are, starting to perhaps lose some of
their mental or physical capacity to make decisions, which is why we put it in our budget submission.
Yeah.
So in our advocacy role in relation to that is one thing that we've encouraged the government to continue working on since the Law Reform Commission produced its elder abuse paper, and there've been a few other issues as well. A few unfortunate court cases, etc. Similar things, tribunal cases and so on. Work has to go on in relation to that.
We're going to see more of that come out of the aged care Royal Commission that's going on at the moment too.
Well,
the financial ramifications that come out of that.
I think there have to be. It's not just about the physical treatment or the medical treatment. I think the financial, because if you're not getting quality treatment, maybe that's because people, haven't been able to set aside sufficient funds.
And that's a monster can of worms that's opening up to all of us who've got older parents or deal with older clients. That it's a big ticket item because to get into some of these aged care facilities, it's not tens of thousands of dollars, it's hundreds of thousands of dollars. So financial advice around how you do that is going to be really important.
So much on the horizon. I hope you found this session useful. Tony and Bronnie and I have tried to put together some material which is now available on the Chartered Accountants ANZ website. We call it our impact report. We've tried to put ourselves in the shoes of our members, various types of members with various types of skills, as we've tried to discuss today. But you'll find on our Chartered Accountants ANZ website this report which says the impact on valuers, the impact on advisory, the impact on SME advisors, impact on financial planners, etc. So we'll keep watching this. My fear, is that we've seen so many Royal Commission reports during our time in practice, and
we get excited by what's in them.
And we get all excited, and sometimes looking back, we can reflect, I guess, on many reports that say, unfortunately, that some of the better recommendations weren't implemented effectively. But we have Labor,
saying that they're going to run with them.
Mr. Barnes will run the whole lot.
And with an election coming up, there will be this sense that both sides of the major political parties will be keen to put their credentials forward as implementers of Hayne's recommendations. Look, thanks for watching us. We hope you've got something out of this session. We hope to be able to do these sessions again, and thank you for listening to us today.